The United States is currently short roughly 4 million homes. Because demand has consistently outpaced the rate of new construction for years, median sale prices have climbed to record highs, leaving a generation of prospective buyers without a clear path to home ownership. Congress recently moved to address this deficit with the 21st Century Road to Housing Act, which represents the most significant federal effort to reform the housing market in nearly 4 decades. The bill passed the Senate with a decisive 89-10 vote. It is built on a supply-side framework, using a system of block grant bonuses to incentivize local governments to accelerate the construction of new units. But the final version of the bill includes a secondary objective. Title IX, Section 901, titled Homes Are for People, Not Corporations, introduces a hard federal cap on how many single-family homes any institutional entity is permitted to own. This provision follows an aggressive populist push to box Wall Street out the residential market. The policy intends to stop large investment funds from competing with retail home buyers for the existing stock of starter homes. However, housing analysts have identified a specific mechanism within this ban that targets newly constructed rental communities. If their projections are accurate, this attempt to protect retail buyers could inadvertently stop the construction of thousands of new homes before they even break ground. Section 901 defines its target as any large institutional investor, meaning any for-profit entity with direct or indirect control over 350 or more single-family homes. The legislation employs an expansive definition of investment control. It covers any entity holding more than 25% of the equity in a project, effectively sweeping in general partners and advisors alongside the primary owners. The penalties for exceeding the cap are designed to be prohibitive. Violations can trigger civil fines of up to $1 million, or 3 times the purchase price of the property involved. Recognizing that institutional capital is often required to fund large-scale construction, the bill creates a list of accepted purchases. This includes an exemption for newly constructed build-to-rent programs, allowing investors to fund new developments. But this exemption has a condition. A home built under this program must be sold to a retail buyer within exactly 7 years. This requirement runs with the dirt. If sold to a new operator in year 5, the clock doesn't reset. They must divest in 2 years. This legal condition assumes that a modern rental community can be easily dismantled and sold off in pieces, ignoring the physical and financial reality of the asset class. To understand why a 7-year forced sale is problematic, we have to move past the legislative text and look at the physical infrastructure of modern developments. Most modern build-to-rent projects are not scattered houses. They are horizontal multifamily, developments that are designed, zoned, and underwritten exactly like high-rise apartment buildings, only spread across a single level. This architectural blueprint shows how these communities are physically structured. Unlike a traditional subdivision, the homes often sit on large, contiguous parcels of land that are legally registered as a single, undivided tax lot. The subsurface utility networks reflect this single-operator design. Water, sewer, and power lines are engineered as a centralized system for the entire community, not as independent connections for separate owners. Complying with the 7-year disposal rule would require an operator to retroactively subdivide the plat and physically re-engineer the utility connections for every single home. This is a massive legal and technical undertaking that the original community was never designed to accommodate. Demanding a developer carve a single unit out of a managed BTR community is the functional equivalent of asking an apartment owner to sell a single unit from the middle of a high-rise tower. While the physical barriers are significant, the financial barriers created by Section 901 are even more restrictive. Horizontal multifamily developments are typically capitalized through master commercial loans. These loans use the entire community and the aggregate rent it generates as the primary collateral for the debt. Selling a single home to comply with Section 901 can trigger a due-on-sale clause in these commercial contracts. This can force the operator to immediately pay off the entire multi-million-dollar master loan, even if only one house has been sold. Public real estate investment trusts, or REITs, face even steeper obstacles. To maintain their tax-exempt status, these entities must follow very specific federal regulations. The 7-year disposal requirement forces REITs to sell assets at a frequency that can violate the safe harbor volume limitations set by the IRS. If a REIT exceeds these limits, it is hit with a 100% prohibited transaction tax, effectively stripping away every dollar of profit generated by the sale. The 7-year disposition rule short-circuits the foundational capital stack of the entire asset class. By making it impossible to secure long-term debt or maintain REIT status, the law makes institutional investment in new housing mathematically unworkable. Because capital markets rely on predictable returns and workable debt structures, the presence of these unworkable statutory constraints forces allocators to abandon the sector entirely. BTR developments require massive upfront investment for land and infrastructure. These projects are only viable if operators can rely on long-term holding periods and economies of scale to earn back their initial costs. Analysis from groups like the National Multifamily Housing Council suggests that the risk of forced sales at arbitrary deadlines will create an immediate chill-it effect on new construction starts. The potential result is the loss of 100,000 newly constructed housing units from the national pipeline every single year. This creates a direct contradiction in federal policy. In an attempt to protect individual buyers from Wall Street competition, the legislation may eliminate the capital necessary to build the very homes those buyers are looking for. The push for Section 901 is driven by a populist narrative that blames large investors for the housing shortage, but the macro data reveals a much more complex picture. There are roughly 92 million single-family homes in the United States. Institutional investors own less than 3%. But in Sunbelt markets like Atlanta, this ownership spikes to 25%, making them a visible target for local frustration. However, the data suggests that these investors are a convenient scapegoat for a much larger problem. The primary driver of rising prices is a decades-long failure to build enough supply to meet a rapidly growing population. Removing a buyer pool that accounts for a tiny fraction of the national market does not fix the underlying deficit of 4 million homes. The ROAD Act effectively uses localized anger to justify a national ban that threatens to lower the total housing supply even further. The housing bill is now moving toward House reconciliation, where its final form will be determined. It faces significant legislative hurdles. Many House members are critical of the corporate bans, arguing that they interfere with free market dynamics and discourage private investment. Industry advocates are currently pushing for a full exemption for build-to-rent communities, arguing that removing the 7-year disposal rule is the only way to restart the development pipeline. If the bill passes with the disposal requirement intact, a frozen development pipeline will stall new housing starts exactly when they are needed most. Lawmakers are now at a crossroads. They must decide whether to prioritize a popular political narrative or accept the mathematical requirements of building more homes.